Welcome. My name is Graham, and I'm the Vice President of Business Development for Axial Capital Management. According to the Fraser Institute, the combined federal and provincial top personal tax rate has risen each year in every Canadian province since 2009. High-income earners now pay anywhere from 47 to a staggering 53% in income taxes at their highest levels. Today, I look forward to sharing with you a federal government tax reduction strategy that's been around longer than both RSPs and TFSAs, and see if it's a fit for you. The Flow-Through Share program has been in our Federal Tax Act since the mid-1950s and provides for over 100% tax benefit to participants for every dollar purchased of Canadian resource company flow-through shares. It is one of the few remaining advanced tax reduction vehicles available today. This major tax incentive is allowed in anticipation that alternative energy, oil and gas, or mining companies will use the money to explore for, discover, and develop new resources, in turn helping promote remote communities and employ thousands of people in the process. The Flow-Through Share program has proven very beneficial over the years for both investors and the country as a whole. According to Natural Resources Canada, the minerals sector alone accounted for 634,000 direct or indirect jobs in 2017. So, what exactly is a flow-through share and how does the program work? Well, a flow-through share is simply a special type of common share sold by a Canadian resource company to help it raise capital for exploration. However, it is quite common for these companies, especially the smaller ones, to have no net income for tax purposes. So they find themselves with no need for the tax deductions related to the expenditures incurred in their exploration activities. The federal flow-through share program allows the company to transfer or renounce these expenses directly back to the investor. Purchasers of flow-through shares can then deduct the expenses against their own personal or corporate income taxes. In other words, the resource company's exploration expenses are simply flowed through to the investor, thus the name Flow-Through Shares Program. The main deduction in the program comes in the form of a Canadian Exploration Expenses or CEE credit, which effectively reduces the investor's taxable income by 100% of the amount invested, thus reducing taxes otherwise owed in the year the investment is made. The program worked very well for many years. However, during the tech bubble in the late 1990s, investor interest began to decline in resource investing, prompting the federal government in the year 2000 to introduce an additional tax incentive into the program known as the Mineral Exploration Tax Credit, or METC, on mining company flow-through share purchases. In the industry, this is known as the super flow-through and comes in the form of a federal 15% investment tax credit. The combined CEE and ITC credits for individuals of 115% enabled the sale of junior resource company flow-through shares to again flourish. Canadians can participate in the Flow-Through Share program by buying units in a professionally managed flow-through limited partnership and gain the benefits of professional management, as well as a diversified portfolio of shares from many different exploration companies in one fund, which helps to mitigate risk. One of the top performing flow-through funds available for many years has been the Pavilion Resources Limited Partnership, offered by Axial Capital Management. Axial Capital is a boutique investment firm located in Toronto that specializes in alternative assets, commodities, and discretionary portfolio management. The company is licensed as portfolio manager, investment fund manager, commodity trading manager, and exempt market dealer. Axial Capital was founded in 2002 by Mr. Daniel Pembleton, who's been working in the financial industry for over 27 years, first as a trader on the Montreal Commodity Exchange, then nearly a decade with RBC Dominion Securities in institutional fixed income, where he rose to the level of Vice President Global Money Markets, managing a portfolio valued at over $3 billion. From there, he founded Axial Capital Management to provide investment advisory services for third-party and proprietary funds, individual managed accounts, and structured investments. As a former institutional trader, Dan has priced debt and credit through various recessions and world crises, so he knows where unexpected risk can hide. Mr. Pembleton's education includes an honors BA in economics from Brock University, an MBA from Western's Ivy School of Business, and a chartered financial analyst designation in 1998 from the CFA Institute. Dan is supported by a team whose areas of expertise include analysis, operations, client services, technologies and workflow, as well as marketing and business development. Axial Capital has designed a number of private equity funds over the years, covering various distinct asset classes, but the longest-running offering has been the Pavilion Fund. Pavilion has already helped close to 1,000 high-income earners lower their tax burden, while at the same time diversifying their portfolios into Canadian natural resources. Pavilion has been, by net asset values, the top-performing flow-through fund in Canada for 3 of the last 4 years and in the top 10 for the past 6 years, even during some of the most volatile markets in recent memory. Here, we see Pavilion leading all major competitors in the years 2015, as well as 2017, and again in 2018. Let's hear from Mr. Dan Pemilton on what helps the Pavilion resource funds outperform the competition.
We saw how Canadian resource pioneers were generating billions of dollars in resource-related wealth and created a flow-through fund that would act as a blueprint for investors looking to replicate this investment style, with the added benefits of tax deductions, a unique hold period of 3 to 6 years, and cash returns. Pavilion funds differentiate themselves in the field by seeking absolute returns on investors' capital and not simply relying on the tax benefits. A diversified portfolio of small to mid-cap natural resource stocks can produce better than market returns over measured periods of time. Using oil and gas, as well as mineral and mining stocks, increases the universe of stocks to choose from and can provide better diversification than either sector alone. An average portfolio will carry as many as 20 or more different resource company stocks.
Thank you, Dan. Now let's look at the full life cycle of a Pavilion investment to see how the process would work for an investor. Firstly, investors purchase units in the current Pavilion Resource Fund Limited Partnership at a minimum of $10,000 or more and are sent their LP unit certificate. At the end of March the following spring, each investor will receive what's called a T5013 tax slip, outlining the number of units purchased and the corresponding tax credits. The investor or their accountant will transfer the credits to the individual or corporate tax forms for filing, allowing a tax reduction for the year the investment was made. All investors will receive a T5013 each year that the fund is in operation, and there will be additional small deductions available on a continuing basis. Almost all other flow-through funds in Canada have short 12 to 24-month terms, which, quite frankly, does not give the resource companies they purchase much time to try and realize a profit on their drilling activities. As we heard from Mr. Pemilton, Pavilion funds are specifically designed as longer-term flow-throughs than the competition for 2 very important reasons. 1, the longer time frame allows the resource companies more time to work through the cycles needed in their exploration activities in the hopes of making profit. And 2, to allow breathing room if the junior resources market goes through a long bearish period. Typically, Pavilion funds will operate for a time frame of 36 to 64 months, although it may be shorter, depending on market conditions. This longer time frame has proven very beneficial for overall returns on past Pavilion funds and truly sets us apart. But this does not mean that all investors will necessarily wait for up to 64 months to see any return on their invested capital. As the fund is fully managed on a day-to-day basis, there are times when the portfolio manager may sell some shares in order to take advantage of price increases and as a method of risk mitigation within the portfolio. At any time that enough shares are sold to make a meaningful cash distribution, the fund will do so. Our history shows that some cash tends to be returned on all funds almost every year throughout their lifespan. At the appropriate point in time, the fund manager will make the decision to liquidate all remaining shares and do a final wind-up of the fund, sending investors their final cash. In aligning himself with investors' interests first and foremost, the general partner works on a performance fee basis, meaning that he gets paid only if there is a cash profit first for investors, and it works like this. Units of the fund are purchased at $10 each, and the first 12% gain in value, meaning $11.20, goes directly to investors. Once $11.20 has been distributed in cash, any future fund profit above that is split 80-20 in favor of our investors. And it's very important to note that all monies received at any time by the investor are taxable as a capital gain, in which half of the returns are taxed. The reason every dollar sent back is taxed is due to the fact that there's 100% plus tax relief up front for the investor. So the CRA deems the original value of the purchase, or what's called the adjusted cost base, to be zero. So capped gains needs to be paid in all returns. However, this tax treatment is very beneficial as it means you are effectively converting income tax payable today at your highest marginal tax rate into a future capital gain. And converting income taxes to capital gains is a significant method of creating wealth more quickly, and is the single biggest reason that flow-throughs are so popular among highly taxed individuals or corporations, along with the goal in the case of Pavilion funds of making a true profit on the unit values themselves. To help clarify how the numbers work, let's pencil out an example for a client we'll call Bob, who lives in Ontario with his wife Mary. The numbers in the example are approximations and won't be 100% accurate, but they will be close enough for illustration purposes. The assumptions we will use are that the value of the fund on maturity is exactly the same as when purchased, and that Bob's marginal tax rate when monies are returned has not changed. The calculations will be more nuanced in a real situation, but again, we'll try and keep it simplified. Bob's taxable income, even after an RSP contribution, is $200,000, leaving him with a tax payable of $70,000. If he were to purchase, say, $30,000 of Pavilion Flow-Through Fund, his new taxable income would be reduced by the CEE credit to $170,000, leaving Bob with only $55,000 owing in income tax, saving him $15,000 in taxes this year, and leaving only half of his original capital at risk in the investment. Additionally, once the super flow-through credit of 15% is taken into account, Bob will reduce his taxes by another $4,500, for a total of $19,500. In reality, the total credits will be reduced somewhat in the first year due to expenses of the fund. However, these amounts will be amortized and recovered over the life of the fund and reported in Bob's T5013 tax slips each year, giving him small additional yearly deductions. Typically, there's about 100% in tax incentives realized in the year of purchase and the remaining in the following years. As mentioned previously, any and all monies received back by Bob over the life of the investment will be taxed as capital gain in the year invested, due to the ACB being zero. In our example, then, Bob would receive the original amount invested, $30,000, back over the life of the fund, and half of that would be taxed, giving him a $7,500 tax liability. But remember, he received around $19,500 in total tax benefits, so even though the investment did not go up in value, Bob is ahead by about $12,000 on his $30,000 purchase in the program. This equates to a 40% return on investment, even though the fund only returned the same $30,000 originally invested. Additionally, if Bob had some unused capital loss carryforwards from other investments in his portfolio, he could now use them to offset some or all of the capital gain owed. Using unused capital losses and flow-through in this way can be a very strategic move. We've seen the power of using flow-through for tax savings and portfolio diversification, but there are a couple more ideas that I wish to bring forward. First is the benefit of using what's called the Pavilion ladder effect. The Pavilion flow-through ladder works in a similar way to a bond ladder in that it helps to diversify the investor over many Pavilion funds and reduces the reliance on any one fund's specific performance or maturity timing. The investor simply purchases some Pavilion LP units yearly for 4 or 5 years as a program, providing a yearly stream of tax savings and cash proceeds from both the periodic and the final distributions from the funds. If we did this over many years, you would simply be climbing the ladder step by step by essentially using previous tax refunds and cash distributions to offset future purchases. In our example, Bob purchased $30,000 of flow-through and received approximately $19,500 in tax incentives. If he did the same in year 2, the result would be similar. In year 3, however, Bob would technically be using the past tax refunds to fund the new investment, again receiving a tax refund. The ladder effect can be repeated as often as Bob wishes. Of course, he will also be receiving some cash distributions from past funds, which would speed the process up even more. Laddering investments in this way is very strategic. The second method of utilizing flow-through is to help offset a large, one-time lump sum from any source. In this case, Bob and Mary have owned a small commercial building for many years and are thinking of selling it. This will leave them with a substantial capital gains tax payable. A one-time larger purchase of flow-through can help reduce some of the risks of this tax burden as well. So let's bring it all together. Flow-through is the only significant tax shelter available today, and it's a smart vehicle for high-income earners and those who realize a large taxable lump sum from any source. The PM has over 25 years of experience in finance and has successfully launched and managed 16 Pavilion funds to date. The current fund is now available for sale, but will be closed for new investment on December 15th of this year, so I would encourage you to speak with your advisor.